So
Yeah.
listen, we've got some really good things to discuss this week in the housing market. There's a lot of moving parts, a lot of things to discuss. So why don't we take it piece by piece? Why don't we jump right into mortgage rates, and then we'll kind of back into everything that's driving that. So give us an update with rates, where they're at, and then we'll get into the drivers of that.
Yeah. So you're right. We did have a really good week. I mean, especially coming from last week where we had just an avalanche. It was like day after day after day of bad news for bond markets. And we got to a place where I was like, we're going back and forth about rates. Like, what are rates right now? I'm like 7.5. And you're like, no, they're not. They're 7.22. I'm like, no, they're like really 7.5. Like, it was a rough week. And it's just a matter of wading through new stuff and new ways of handling that. We've never raised rates this fast. We've never been through a pandemic. We've never done $1 trillion spending packages. We've never had rates go up so fast that now all of a sudden solvent banks that are solvent in 12 months are insolvent because people want their money now instead of waiting. So there's duration issues and all these new things. So it's really charting new waters, and it's hard. It's hard to predict. It's hard to look at the past and understand what's going to happen in the future. And so you kind of go day by day, and we're on this roller coaster. And I told somebody this yesterday because rates were better. So last week he's a first time buyer, nice guy. He's in a very difficult market in the 200,000 range, which is the cash market almost, and that's who you're competing with there. And we were talking last week. I'm like, look, we can kind of play with the numbers. You're getting some credits. We get you like 7 3/8 or 7.375. And he's like, okay, this is going to work. Payment works. Didn't end up getting that house. Got a house yesterday at 6.79.
Wow.
Same terms, not paying any, first time buyer, not paying any points, like that kind of thing. So we're starting to see those higher mid sixes come back. And that's literally in a 7-day period. We saw basically a 0.75%, half to 0.75% change in rates. And so big moves, right? I mean, that changes every $100,000. That's like $700 a year, which comes out to like $61 a month for every 100,000. So your median home price is $436. This was a $250 a month or $3,000 a year swing for a family buying a house based on different news that we're getting, and it's that fast. So
it's amazing. So
kind of interesting, right?
Yeah, well, yeah, it's great. It's what we've been kind of waiting to happen. I mean, we thought it would happen earlier. We thought it would happen faster. It's happening now, and I think, and we'll get to this, but if rates continue that downward trajectory, like a lot of economists believe will happen, this will be the unlocking of the housing market, transactions mainly. That the worst would truly be in our past if rates continue to tumble down. So the question then is, how do you see us moving forward from here? Do you feel as though rates will continue going down, or do you think there's still some turbulence ahead?
There's still turbulence ahead. So
because
we are, going for the next 60 days are definitely going to have some heartburn in them. And the main reason for that is because we had a couple of lulls in inflation last summer. So we're replacing June numbers with the CPI, which we'll talk about in a minute, this month, which was really great news. The CPI number for last July was pretty good. It was a pretty low number, and so was August. So we will likely see some heartburn there. The one thing, though, that we have to keep in mind is that the Fed came out over the last 2 weeks, and they said in no unclear way that they plan on raising rates 2 more times this year. And I was listening to an interview with Liz Ann Saunders, she's the chief investment strategist for Charles Schwab, and she said, the markets already, they're definitely 100% are already baking in the rates being increased on the 26th of this month. And when you look at like the Wall Street bets on what the probability of them raising rates at the next meeting are, another 25 basis points, are still very high, which means these traders are already taking those into account. So even if some of those CPI numbers come back worse than we thought, they're going to have less of an impact on that day-to-day trading, because we're already aware of that being a possibility of how they're going to combat that, which is going to be, they're saying they are going to raise these rate hikes. If we see those inflation numbers come in at, at a minor, in like at a this, like basically staying steady or being like a very, very small increase for the numbers that we're replacing, that'll be very positive for the bond market. We'll get a lot of chatter about going back to pausing rate hikes or potentially only seeing one more rate hike this year, even though the Fed was very persistent on that. Part of their persistence comes from not letting the party on Wall Street get out of hand. If you look at it, we've been on a really nice rally. We've got bank earnings out today. We've got airline earnings coming out. The banks really lead the earning front from the retail side of things. Like next week, we'll see retail sales, and a lot of these are already coming out stronger. So we go back to that battle with like how we're trying to destroy demand and we're trying to manage a job market. And it's that part of it. That's like, while it's good to see that, it's still tricky because if people are still, if the labor market's still strong and these corporate profits are still strong and people are still out there spending money, the Fed's like, okay, what do we have to do? But at the same time, the actual inflation data is showing the numbers trending down. So it's just turbulent, right? It's going to be a little bit turbulent. The good news is those rate hikes are baked in. That's kind of what everybody's planning on doing. And the Fed is really just trying to keep the party on Wall Street under control at this point, in my opinion.
Yeah. So, in your opinion, how do you see the job market playing out? Because that'll be a big driving factor in this demand destruction, and ultimately how the bond market responds to unemployment. A lot of people say, well, unemployment is like a delayed KPI, and so the jobs report, the last two, kind of hurt us because unemployment is also being very challenging in that it's not going the direction that I think the Fed wants it to go. However, the future jobs report, do you see unemployment starting to go up over time?
So the BLS jobs numbers, while they've been going up, that's like what the Fed really, for some, they don't pay much attention to ADP much at all unless it absolutely blows things out of the water, which it did this last month, which was kind of a strange thing, which again was mostly service and hospitality, which is
Right.
not, that's second jobs, dude. That's people trying to keep up with inflation. That's not, those
Absolutely.
aren't your 80, $90,000 a year people. This is restaurants. You have to think restaurants and hospitality still are not back to pre-pandemic employment levels. They are
Wow.
still short staffed. And so there's still some demand for those jobs. But the BLS report, which is a government jobs number, that was actually, so we missed that. If you remember, last Friday, was it last Friday or the Friday before? It was last Friday. We missed that number. It came in lower than expected. And they revised the previous 2 months down by a total of 110,000 jobs. And so those would both be misses at those
Right.
months. So
Exactly
we
right.
are starting to see some of that weakening. Now, you have a couple things going on beside that, right? So you look at the unemployment rate, which went down some, but there's also some people leaving the job market or not participating in the job market that can make up that unemployment rate. So that number is kind of a tricky number. So that's when they started to look at hours worked and wage growth. Wage growth is slowing slightly, and hours worked is decreasing. While it's like, fractions of hours, but if you factor that out over every single person that's paid by the hour, it's actually a big number that comes out of the economy. And so I think you're right. I think we're going to see the BLS numbers continue to soften. The last 30 days for the unemployment claims, which have been trickling down a little bit, which would show that more people are, or less people are filing for unemployment. I mean, if you think about it and just think about personally, and especially in the real estate business, is how absent and how at idle this business has kind of been. And it goes almost back to like Juneteenth, right, which was like a federal
Right.
holiday. So we're looking at shortened week after shortened week after shortened week, July 4th mindset, all of these things where that there might be like, the thought is that there's a lot of people out there that just simply didn't file a lot of that paperwork because, I mean, it's summertime, we're rolling, I
Yeah.
guess, so there's been some shortened weeks in there where you're not seeing a lot of that activity. So to your point, I do think that especially as we roll into the winter months where seasonal jobs and things like that are really starting to cut back. And you see not a lot of those people, those jobs ramping up like they are doing right now. I think we'll continue to see that number soften a little bit.
Yeah, and I think that's a big um, caveat to this whole thing. That if unemployment, like if the Fed starts to see, well, scratch that. If the bond market starts to see that take place, then mortgage rates respond in a way they respond by going down, right? And so,
Yeah.
um, just like they did this week, based on the CPI report. So why don't you unpack that and tell us what happened with the CPI report and why the bond market responded the way that it did?
Yep. So CPI report is the consumer price index. So that's the price we pay for stuff. So the headline inflation number on that went down 0.2%, which was lower than the estimates. So that went year over year. Headline inflation is down from 4% and it's down to 3%. So we really saw a much bigger improvement in headline inflation than we thought. Now, the number that the Fed is really watching, or they call it core inflation, and they've even got super core. They've got all these, they're moving the goalpost on that 2% number, but essentially they're looking at core inflation. The economists were looking for that to increase 0.3%. And we saw it only increase 0.2%. And then year over year, it's down from year over year, it's down from 5.3% to 4.8%. So we saw
Wow.
a really, really nice decrease in that core CPI. And in the places we saw some decreases in shelter cost. We saw it for lodging away from home, like so hospitality costs, vacation costs are starting to soften. And then also for the second month in a row, we've actually seen declines in used car prices month over month, which was really driving the economy. So those numbers, you know what's one number that really stuck out to me on there, because again, I'm always thinking Main Street, like what do
Yeah.
people actually pay for and think about, is that motor vehicle insurance is up like 30% this year, which
Wow.
is pretty wild, and you got to think that's going back to the cost that insurance companies incur is the cost of repairing vehicles. And so you go back to talk about a lagging effect is like all the shortages of parts and increased costs of parts, increased costs of labor to get cars fixed. So it's just these insurance companies are looking backwards saying, oh my God, these are all these things we paid. So now it's time to start repaying some of those costs. So either way, though, really, really good news on the CPI front, which we were looking forward to and really needed, to kind of break that avalanche that we were going through.
Yeah, I mean that was the thing that impacted mortgage rates the most this week, and so much so
Yeah,
the chief economist for NAR came out and made a public statement to the industry to say, "Hey, this is a huge, massive win, because of what it's going to do, how it's going to unlock the mortgage market." I bet you next week mortgage apps go through the roof because every loan
yeah,
officer in the country is having conversations with clients to say, hey, here's what's happening with rates. And we see this every week over week over week. I'm looking at mortgage applications. It's a direct correlation to rates, obviously. So when you have a huge dip like this, I bet you mortgage apps go up like crazy. So hint, hint, realtors, get your buyers out there this weekend. I bet you there's a lot of accepted offers. I bet you there's a lot of offers placed this weekend. So it'll be interesting to see. So what
yeah,
else
for sure.
happened this week? What other data points got released this week that's really driving the market?
So there's two more. So PPI, which is producer price index. So that is what companies are paying for the goods that we buy. So that if you think about it, that's kind of like that's adding the water to the Kool-Aid, right? And then the CPI is the Kool-Aid. So that PPI rose 0.1%, and they thought it was going to rise 0.2%. Sorry, I'm looking at my notes when I'm reading this, so I get my numbers right.
Great.
And then year over year is down from 0.9% to 0.1%. So that CPI number PPI number was a massive, massive win, and it really kind of took CPI, which really helped the markets, and then we add the PPI to it, and then we added some sell off in the European markets and things like that. So we really had really nice news for bonds. Now today, bonds and mortgage backed securities are down a little bit. which is expected. That's just kind of everybody getting their bearings straight after we saw mortgage-backed security prices improve by 200 basis points in a 3 or 4 day window. And so all of those things together really put us in a nice spot on rates. The other number that came out this week that I thought was pretty wild, and you could interpret it as a good or a bad thing. It depends on whether or not you own a house or you're trying to buy a house, but is that home price appreciation came back. And I mean, it's pretty staggering. I mean, they're talking about an annualized pace of almost 10% increases, 10% appreciation over the next 12 months through CoreLogic, which again, I mean, we're right now based on those appreciation figures, we'd be sitting at the highest, again, touching the highest level of property values that many of us watching this or working in this industry or homeowners have ever experienced in that perspective. So again, we talked about this
Crazy.
before. Inflation is a compounding number, right? So if inflation was up 9% last year, then it's up 5% this year. The price of your potato costs 14% more because it's compounding. The same thing happens with home values. And we try to explain this in January when we were having these conversations, when we saw some retraction, is that home prices were up 22% or
Yep.
something last year. We go up another 10%. Well, that's 30%. And so as somebody that's going to buy a house, like I feel for you, that's not easy. And I did some research on median home prices and payments and stuff like that. But it's at the same time, if you own a home, which more people own homes than they have any other type of investment, is just a really good place for people from an equity position. And as we start to see rates come down, you will start to see people continuing to utilize the equity in their home because, as we see all the time, credit card debts increasing, home equity line of credit use is increasing, and now people have more ways to consolidate those things and utilize some of that home equity down the road, which will be interesting to see. But nonetheless, I mean, crazy numbers.
It is crazy because for the last 2 years, people are calling for the housing market to crash. Now, yes, transactions are down like crazy, but home prices are going up,
Yeah.
and that's when we talk about a housing crash. That's the context, right? We're talking about the prices of homes, and it seems like nothing can penetrate home prices because this crisis of inventory, and that's the name of the game. And once going back to the CoreLogic report, the reason why that 10% appreciation comes back is, again, we see rates in the high fives, low sixes. You're going to see a frenzy, and that's just going to bring all this pent up demand explode in the market, driving the prices just through the roof yet again. That's what CoreLogic is seeing, and that's what you and I have been saying for 2 years.
Mm-hmm.
And that's the reality of the market. That's why, I'm having a lot of conversations with, quite frankly, a lot of people in the industry thinking about leaving the industry, loan officers and realtors. And you and I are singing the same song. We're like, listen, it's difficult right now. I understand. You came out of a easy market, quite frankly, over the last 5 years. And yeah, is it hard now? Yes. But if you can weather this storm, the people who end up in this industry next summer are going to just be like so happy. That is my belief. That is my prediction that the summer of 2024 is a really, really good market. I bet you we have 30%, 20 to 30% less competition, less agents. Rates are in the mid fives. Inventory is still low. Prices are still way up. And it could be, I might eat my words, a better year for realtors and loan officers than 2021.
I agree. I mean, and I had a meeting with a loan officer about it yesterday, and I said, this isn't the time to abandon everything you've done and
Right.
change everything you do. Like I said, this is the time. I've been doing this since 2004, right? And this is, we saw 2008, 2013 was a rough year. 2015 there was like some
Yep.
ups and downs. Like, this is not our first rodeo with up and down markets. I can tell you that. I was talking about on my wedding day. I got married on a Saturday. On Friday, I got paid. And it was $84, and my W-2 in 2009 was, and I was younger than, was over $250,000. And that was in
Crazy.
literally 12 months later, and so it's these
And
times
that was a
that
nice wedding. I was there.
thanks. Yeah, thank you. It was a good time. Remember, I've never mind. All right,
Yeah.
so I was about to go way off. So,
Okay.
but there's these are the times when you just continue. Like, not every day is going to be a win right now in this market. There's going to be weeks that you go home and you have no tangible gain from everything that you've put into your business. But this is a time when you don't start all over again. Like, it's not the time. Like, this is when you double down on the people that being involved in your communities, buy some school supplies. If you have kids, get involved with their schools, and use some of this time to get away and dive back into that peer group around you, because they're the ones that are going to look to you as things start to change, and as the housing market and the mortgage market and all these things come back into the news. You're the guy that they're all going to go to, and you're the guy that was there when it was slow, and you're helping with these things, and you're just continuing to build all these relationships. It's not the time to change course of everything you do. You just have to stay on that same path and hope like hell that you followed what everybody tells you over the past 2 or 3 years, when money is raining from the sky, to make sure you set some of that aside and weather these storms, because there will be another bright day. And I am agreeance with you. Who knows where rates will be, but I do think they'll be lower next summer. I also think that, if you look at housing starts and new construction right now, is absolutely bananas. And
Yep.
if I'm an agent, and as a loan officer, I've done this, I've done more training, and I'm looking as for our company at more options for construction loans. But if I'm an agent, I'm learning more about new construction. I'm learning more about how I can be involved in helping with whether looking at buying land or what kind of home they're looking at building, to make sure I take advantage of that, because new construction starts were up like 20%. And these builders out there are going to be the ones that are going to start to call the shots on prices and costs and all these things. And they're going to start to take control of that market. And as an agent, it would be a good idea, in my opinion, and as a loan officer, to become more well versed in that market.
100%. Two things you said that are spot on, and I think it's a great takeaway for everybody watching the housing market this week or the housing market update this week, I should say, is the fact that we are in a pipeline building market. And the thing is, if agents can wrap their minds around, like, okay, maybe people aren't doing anything right now, but I could build this massive pipeline of people that will do something over the next year, they will be ahead of the market when it does explode again. And here's the thing, to your point, everybody who's looking at stopping everything and stop doing all the things that got you success in the first place, when the market explodes again, they'll all be behind the market, Steve, and they'll chase it. It's like,
Yeah.
they'll try to ride the wave and they'll miss the wave. And if you know anything about surfing, which I do not, but I would assume that when you're riding the wave, you got to get in front of the wave. It's like the kid on the boogie board. Everybody who can double down right now and stay focused and build a pipeline, you will get in front of that wave, and it will take you to extraordinary success levels. But people that don't, to your point, who are like, I'm gonna stop being a realtor, maybe I'll go be a loan officer, maybe I'll sell insurance for the next couple of years, and they try to get back into this, they've missed the wave and they're behind it. That's the way I look at the market right now.
100%.
So appreciate you like always. Everybody in the live audience, we will see you next Friday for another weekly housing market update. Steve, thank you. Appreciate it like always.
Thank you. See you guys later.